All right, that concludes our discussion of interest, and we're now ready to move on and talk about charitable contributions. All right, once again, you got to pay attention to the details, right? Many things are charitable, but they do not schedule a charitable contribution made. So details are important, right? First thing you have to have is a qualified charitable organization. A 501c is what we call it in the business. That is an organization that has filled out the paperwork to convince the IRS that should be able to collect monies from individuals and organizations without that being an income creating event. And in addition to that, the person writing the check should get a deduction. So those political PACs and other organizations that you may have read about in the news, they do not have to pay taxes, but they're not a 501c, and so you cannot take a tax deduction for making a contribution to them. You also cannot make tax deductions to individuals. You cannot take a tax deduction if you give to the Red Crescent instead of the Red Cross, because the Red Crescent is not a 501c. It's a charitable organization under another company's rules. Now, that does not mean that you cannot give to a specific fund within the Red Cross, which is dedicated to an aid of a specific country. It just has to be, the check has to go to the Red Cross originally. And then no political organization, no matter how needy your congressman might be, giving money to any of the big PACs or to the NRA or to any organization whose primary purpose is to promote a political agenda will create a tax deduction. All right, there are a few more requirements for charitable contributions. First of all, you actually have to give them something that you have some basis in. That's generally money or other property. So that means that you cannot value your services. I normally would get $100 an hour. I worked for 3 hours. Therefore, my charitable contribution is 3 hours, because you just don't have any basis in your time. You can take related out-of-pocket costs. You have to spend money to buy raw supplies. You're a Girl Scout leader and you have to buy a uniform. Those kinds of things would be deductible. But if you want to deduct your mileage to and from a charitable organization, you use a flat rate of 14 cents per mile. So I record books for the blind. I could count my driving to the recording studio as part of my charitable deduction. When you give gifts of property, the first thing you have to do is classify the kind of property it is in order to determine the tax deduction. The first of these classifications is called ordinary income property, and that includes inventory, everything you would normally hold out for sale in the ordinary course of your business, and everything else you might own if you've owned it less than a year. If you have ordinary income property, your deduction is limited to the adjusted basis in that property unless the fair market value is smaller. As a general rule, with the exception of inventory, what you're going to see is if there has been a decline in fair market value between what you paid for it and what you could currently sell it for, that's considered a non-deductible expenditure, and you cannot take a tax deduction for that. Inventory is a slightly different animal. There's an underlying principle that when you spend money to make money, you have the right to recover your investment. So if my cookies are stale dated and I throw them away, I would get to take a tax deduction for my inventoriable costs. Therefore, if I had to follow get fair market value if fair market was smaller for charitable contributions, I would probably throw the cookies away instead of giving them to the charity. So when I spend money to make money, which is my cost of my inventory, I will always get my adjusted basis if it is larger than fair market value. There are some AGI limits, the most common of which is the 50% of AGI. So if you're making $100,000, you cannot give away more than $50,000 and take a current contribution. We're not going to spend time on them. They're in the book, they're in your pub, should they apply. The second category of gifts of property is capital gains property. So that would be things that are not inventory that you have owned for more than a year. In this case, the deduction is generally fair market value. This is a good thing if you paid $1 for something that's worth $1 million, because you can deduct the full $1 million without having to pay any taxes on the appreciation. It's a bad thing if it's your Goodwill stuff. You bought a pair of jeans for $100 and you wore them down to the bare nubs, so that a conservative estimate for a resale value or fair market value would be $2. You're stuck with the $2 deduction. You are in some cases limited to basis instead of fair market value if the first category is the unrelated use by the charity. So if a charity is its mission is to educate, then the property that you're giving them must be used in their educational endeavors. If you sell it, if you give it to them and they're going to immediately resell it through an auction or something, that's not a related use. Now, that's generally not an issue because if you've got $1 million Picasso, the charity wants it. They have to keep it and use it for 2 years, and then they're free to do anything they want to it. So they are going to give you all the documentation you need to guarantee that they were excited and thrilled to get this Picasso, even if they're a fine Renaissance museum and nothing else in the entire building is older than 1500. They will use it legitimately for 2 years. They'll give you the paperwork, and then at the end of the 2 years, they'll dump it and get something they would much rather have. The other time when you're limited to basis is if you give to a non-operating private foundation. We're not going to deal with any of those rules, but remember that you cannot just give money to an individual and take a tax deduction. So rich people like to have both sides of the cake, right? So I create the Carnegie Foundation. I create the Spindle Foundation, and I am on the board, and I'm the principal decider of who gets things. Well, I'm really kind of circumventing the system, and I really am making contributions to particular individuals. So that's what a private non-operating foundation is. And if you have such a thing, you're always limited to basis. But I don't see that as a big issue in any of our immediate futures. And then we have those AGI limitations that we're pretty much ignoring. If you choose to deduct the fair market value, you're limited to 30% of AGI. So if that Picasso was valued at $1 million and your AGI was $1 million, you could only deduct $300,000 this year, next year, the following year, and then the last $100,000 in the following year to get all of it. So if the difference between fair market value and basis is small enough, you might choose to use the adjusted basis and get the full 50% of AGI limitation. Not something you're likely to see. So now we're going to deal with a series of examples. As you work through each one, your first question is it ordinary income or capital gains property? Ordinary income if it's inventory, no matter how long I've owned it, or everything else if I've owned it less than a year. Capital gains property, did I own it a year or more, and it is not inventory. If you decide it's ordinary income property, you're going to use the lower of adjusted basis or fair market value. Unless, of course, it's inventory. Inventory, you get your adjusted basis, even if it is higher than the current fair market value, in order to keep you from just throwing it in the trash. If it's capital gains property, your first question is there related use? Is the charity using it in its mission? If the answer is yes, you get fair market value. All right, this is the first of 4 examples of charitable gifts of property. We have a boat. We're giving it to the Boy Scouts. We, in this case, have used this boat personally since 1997. We're giving it to the Boy Scouts for the annual auction. All of that information is important in determining whether it's ordinary income or capital gains property. If it's ordinary income property, you're going to get the $9,000. If it's capital gains property and there is a related use, you're going to get the $11,000. So ordinary income, use the lower of adjusted basis or fair market value unless it's inventory. If capital gains property, is it related? If it's related, use fair market value. If not, use adjusted basis unless it's larger than fair market value. So take a second, think it through. Hopefully you have concluded that this is capital gains property, but not related use. Right? Not inventory, we've owned it for a long time, but the Boy Scouts are not in the business or mission of selling things. They're in the mission of turning boys into men. So we would flunk the related use. Therefore, we would be limited to cost or adjusted basis. Okay, here's our second set of facts. Only one thing has changed. Everything else is exactly the same. Ordinary income or capital gains property. Same use, so it's going to be capital gains property. So what has changed? Is it now related use? If it's related use, you get the $11,000. If it's not related use, you're limited to the $9,000. All right, hopefully you concluded that to use the boat is a related use, help young men be strong and understand the outdoors. Therefore, the tax deduction would be the full $11,000. Here's the slide again. One thing has changed. So is this now ordinary income or capital gains property? It's not inventory, but how long have you owned it? Hopefully you're saying less than a year. Therefore, it has to be ordinary income property. And in that case, we don't really care what the Boy Scouts do with it. They can chop it up for firewood for all we care. All we're going to get is our adjusted basis. So the answer is $9,000 because it's ordinary income property that is not inventory. All right, last example. Take a minute, see what's different. All right, it's been owned a long time, right? But is it ordinary income or capital gains property? Because it's inventory, hopefully you have concluded that it is ordinary income property regardless of how long you own it. Therefore, I'm going to get my adjusted basis. And so my adjusted basis is $9,000, and that is my deduction. And here are the 4 answers. All right, this is just an example of what we call loophole closers. When Congress needs money, they ask the IRS, where do we find people pushing the limits? Where are there places where if we made the law stronger, people would take smaller deductions and we generate more revenue? And so there's a lot of these in the charitable contribution area. It used to be that if I was a big game hunter and I went out and shot myself a bear, I could get the bear stuffed and give it to a museum, and I could take a charitable deduction for everything, my airline ticket, my ammunition, my guide. Now all you can take a deduction for is the cost to stuff the bear. So there was some unknown number of great white hunters out there who were taking big tax deductions relating to their hunting trips. Now not so much. And so what does Congress do? Congress says we now are going to generate X dollars of revenue because people can't do this anymore. And so now we can go spend it somewhere else. So there's a lot of these that we're pretty much ignoring. If I wanted you to look up one, I would give you a fact pattern and I would say, go look at the Pub 17 or the instructions for Schedule A. But I did want to mention the contribution of cars, boats, and planes because a lot of people do that. Give your car to the Kidney Foundation, give your car to X. And what happens there is you're asked to value the car. And what happened before this law change is you didn't have much guidance, right? You had a blue book value, good condition, bad condition, mediocre condition. And so nobody giving their car to the Kidney Foundation ever had a car that wasn't in excellent condition, right? So people tended to overestimate the value of their automobiles. And so now, if you choose to give your automobile to an organization, your deduction is limited to whatever they can sell it for. So they actually have to send you a letter saying that we're so grateful we got your car. We sold it for, and probably that number is a whole lot less than you ever imagined. The only exception to that is if the organization kept your car or your boat. Remember the boat we were given to the Boy Scouts? If they use it, then there'll be some sort of appraisal value and you'll get the fair market value. A few more limitations. The AGI limitations, I said I would not test you on them, but be aware that rich people have some restrictions. When you look through the homework here or you're preparing for the CPA exam, do be aware of at least the 50% of AGI limitation, because they tend to tell you John's got $100,000 of AGI. He gave $75,000 to his church. What is his charitable contribution deduction currently? And remember, he can only deduct up to $50,000 because he can only deduct 50% of his AGI. But you will not see this on a test. And those private foundations, they have more strict rules. Not only can they not deduct the fair market value, their overall dollar limitations are smaller. And then what happens to excess contributions? We have to use them within 5 years. So you have a 6-year period, the current year and the next 5 years. They retain their character. So if it was a 50% of AGI deduction, it will always be a 50% of AGI deduction. Can't go back. Later on, we'll look at some items where if you can't use it, you can go back, amend a prior year return to get a faster deduction, but not here. All right, our last 2 slides deal with loophole closing in the area of charitable contributions. Remember, Congress needs money, so they asked the IRS who tends to push the envelope. What kind of taxpayers seem to be taking larger deductions than were really intended. We want to write the law tighter. We want to keep them from doing that so we generate more revenue so we can spend it someplace else. Well, it turns out there are a large number of people who would tend to buy Girl Scout cookies. Let's say $300 worth of Girl Scout cookies. You're really Jones for them, right? So you have a check. It says $300, Girl Scouts of America. It's time to do your taxes. Well, I got a check made out to the Girl Scouts. I must have a tax deduction, conveniently forgetting or ignoring the fact that you ate all those cookies. So when they were closing loopholes, Congress decided that for any individual charitable contribution greater than $250, you got to have a letter from the charity. And that letter must explicitly state whether or not you have received any goods or services in exchange for that contribution. So you love football, you love Southern football, you graduated from Georgia University, and they got a heck of a football team. But the only way to get decent tickets is to be a part of the alumni group. So back before this rule was changed, you would make a $1,000 contribution to the alumni group, and they would send you 4 football tickets. And you would take a full tax deduction for the $1,000 because, hey, you wrote a check to a 501c called the Georgia University Alumni Group. Now, in order to take that deduction, you need a letter from the charity. And the charity is going to say, we were so thrilled to get your $1,000 check. In return, we did give you 4 football tickets worth $250. So your actual charitable contribution is only $70 and $750. And if you're audited and you do not have that letter, you will have your deduction downgraded or disallowed completely. Now, getting the letter is not much of a problem because charities send them out automatically. You give them $10, they're going to write you and say, I was thrilled to get your $10. No goods or services were received. And when are we going to get your next $10? All right. The same thing happens if you buy a ticket to an event. You pay $100 for a rubber chicken dinner in support of X charity. The charity did not get to clear $100, right? They had to pay for the food. They had to pay for the rent of the facility, the printing the brochures. And so what they will print on the face of the ticket is you paid $100, the charitable contribution was $35, and your deduction is limited to the $35. And in that case, they don't need to send you a letter because your documentation is the ticket itself, the ticket stub, and it's got all that information on it. Okay, a little bit more on documentation. If you give an individual piece of property that's worth more than $500, that's one individual piece. If you give 14 different items that add up to $600, this provision does not apply to you. But if you give a couch that you want to take a deduction of $800 for, then you need to attach this form. Once again, it was perceived as a loophole closer. People don't tend to be as proactive about cheating if they have to leave a paper trail. So instead of just relying on the potential of an audit, it's now your legal obligation to make sure that you have the information at the time you take the deduction to establish the deduction. And so you need to be able to demonstrate that the couch was indeed in good condition, that other couches of a similar nature at a thrift store were selling for $800. It's always strongly suggested that for larger items, you take pictures and detailed descriptions so that if the IRS does come and audit you, you can say, see, I did my due diligence. If you give very large things away, anything greater than $5,000, you need a formal written appraisal, and that appraisal has to come from someone who's an expert in that particular area. So an art appraiser can only appraise art, not real estate. And it might even go so far as to say, if I'm a specialist in Renaissance art, I probably should not be appraising your Picasso unless I have expertise in that area also. And this particular deduction is a miscellaneous 2% deduction. It is not benefiting the charity directly, the cost of the appraisal. It is monies that you have spent in order to take your tax deduction. A few concluding remarks. Remember, don't memorize anything, but on the other hand, some of you are really reluctant to look it up. When in doubt, find an index, read, and reason to an answer. Remember not to read the book cover to cover. Here, the tax returns are the most important thing that will aid your learning process. Use your Pub 17 and your instructions for your Form 1040 to get the tax returns done carefully. I will use these schedules that you're filling out as a basis for a lot of questions. Do try to get to the end of chapter questions relating to charity and interest, but they're not as important now, at least in this section, when you have the tax returns that are really guiding you to start thinking coherently on the material in hand. But it's always a good idea to check the solutions. You never know when they might make your life easier. And then, of course, remember to read questions carefully, especially on the Blackboard quiz. A lot of the questions are calculated responses. You don't want to waste a whole lot of time because you haven't read the question carefully. Make sure you know what I'm asking you for. And if you get stuck, remember you are more than welcome to send me an email, give me a phone call. You're not in this alone. My job is to help whenever I can.